All right, let's go. Okay, so thank you for being here. For people watching, we do a couple different types of videos on these podcasts, but many of these roundtable styles are this pricing in the news concept. So we bring headlines. Obviously, Jeet, Pete, and Adnan are on our leadership team. They're subject matter experts in pricing, sales, profitability topics, and we kind of jump all over the place with trends, implications for commercial teams, and profitability in general for companies. So today we're going to try something different, which is jumping into private equity topics for kind of a deeper dive. So here we go. So there's a couple things recently, I would say in the last couple of months, just in terms of companies, some public companies going private, and then you've got private companies going public. I'm starting with Birkenstock because of the tie to the Barbie movie. So Birkenstock, the headlines point to a $9 billion valuation, which in my opinion seemed higher than what I would expect. But a couple of the articles that I read said that because of the big cameo in the Barbie movie, that helped them with a boost of sales. So there's Birkenstock. Subway also just made a couple of headlines. And so maybe we just start there. What triggers a change in ownership? Like from a private equity perspective, what prompts something like this to happen?
Like I'd say it could be a couple things. I think in the case of Birkenstock, it was probably a recognition that the iron was hot, and there's this whole reversion to what's old is new again. So I think that's probably something you see in all different like fashion industry, which is its own world. But I think yeah, the Barbie movie gave it a pop, and then I think owners want to take some money off the table or get new investment to grow. And your options when you're at least a company of a certain scale is you can either have you can sell to either another group of investors, and that could be either people within your own company, it could be another private equity company, it could be the public markets. And so I think those are generally your options. And the bigger you get, at some point, a public exit becomes where you can get more capital most easily. So, and then I think where private equity is growing, and you can think of, depending on what measure you talk about private equities, 5 or 10% as big as the public markets in the US, so really a relatively small slice. But for all of these SMB companies or even middle market, it doesn't make sense for them to go public. So it ends up being, a private equity business model is to consolidate a bunch of folks in the same industry and get economies of scale and manage things more professionally that were previously mom and pop. And then that makes sense for a lot of owners as they're either getting ready to retire or looking to grow in a way that they don't want to fund through just a bank loan. They might want some expertise and management insight alongside it, someone who's been through the ringer before.
That makes a lot of sense. And in the case of Birkenstock, it just seems like they had put on the table some strategic growth initiatives. In their case, what they publicly said was they wanted to pursue growth in Asian markets such as China and India and such. But to your point, that's likely going to require some funding. But if they're going to do it at a time where they're getting some incremental press because of things like the Barbie movie, this could be a good time to pursue a strategy like that, as long as they do have the funding. So perhaps there's a case where previous owners were like, yeah, we could pursue the growth, but we don't necessarily have the appetite or the desire to take on a risk. But there's another funder out there that is. So let's give it some thought and do the right thing for our investors.
Obviously, the placement in a movie like Barbie is a big lift, I would think, just in terms of like visibility and all that kind of stuff. But what are the other ways that companies can boost their valuation with something like this?
Yeah, I think, from besides what Pete and Adnan just talked about, I fundamentally believe changing of ownership is because you want to do something different. And we know that valuation is really it's like a willingness to pay type of variable, where it can change. The value is in the eye of the beholder sometimes, and that valuation can change pretty quickly. So yeah, I mean, is the Barbie movie having an effect? Probably, but if you're going to make a change like this, I'm hoping that they have something in mind to fundamentally change about the business, because you have to add some level of value, right? When you're making this kind of change. So are they going to change how they go to market? Are they going to change their price metric? Are they going to go into a different direction of the brand itself? Because the brand has value. So are they going to go into other things besides footwear? Are they going to go into whatever else, making surfboards? I don't know. But you want to make some fundamental change, because that's how you're adding value. So when you reopen this for the next investor or the purchaser, that you're able to get that next level of bump that's there, right? So oftentimes we'll see public companies go private, not just because of exit, like Pete correctly talked about, and Adnan did too, but you want to go there because you don't want that backlash coming back from the market, because you're going to do something drastically different. You're going to go direct to the end customer and not through the resellers anymore. You're going to, technology-wise, make some fundamental changes. You're going to go to China and you're going to open up that market for yourself. You're going to do these things that if you are in the open market, your stock might tank for a period of time, and you don't want to go through that up and down period. And so you come off the market, you restructure yourself, you sell off unprofitable pieces of business, you fundamentally change how you're going to market, and then you reintroduce yourself to the market. And you get another bump by doing that. Now you're financially stronger, you've got better margins, hopefully, and you've got a business model that's more sustainable over a longer period of time. So that's typically where and when we see these things happening. And for us, it's a great opportunity, because we're able to go in and to help with some of those changes, because we know, one of the best things to do when you have a commoditized environment or a stagnant environment is to change price metrics. Price metrics is one of the easiest ways you can go in and give a little boost to yourself, put some makeup on yourself basically, and reintroduce yourself to the market. And it's just a great way to do it. And companies do it all the time when they feel like they've kind of hit that point where everything is a little stagnant. They'll change their metric, or try to change their metric, into giving themselves a little bit of breathing room. So it's a good point for us to get into.
Well, to Adnan's point, like in the Birkenstock case, to stay on that thread, getting access to the Asian market might be best accomplished through an investor that already has established distribution and channels there. And then you kind of have all this cross-sell synergy, and then that boosts the value of the company. So Jeet, to your point about dynamic value drivers, you change the situation, you change the valuation, and it's different for a different buyer. If you actually have that, you establish it, and then the company, Birkenstock, will endure those new relationships and customers that they acquire there. It doesn't have to be because of that owner. Then someone else can buy it. And then on the flip side, you could think of, there was a story recently about WeWork. I think Taylor Swift generated more economic activity in LA over a week than WeWork is worth. And all that WeWork is about, it's like they basically have $350 million in cash, and more or less that's what the investors think will remain in the case where the value goes to zero. So if it's liquidated, they'll at least get that, and hopefully a little more. So it's kind of an interesting way to think about that.
Taylor Swift is really
we hit
everybody.
We hit Barbie, we hit Taylor Swift. Yeah. These roundtables are really taking off now.
What podcast is this? Who authorized this?
It's the economy.
It's great. Last thing I'll say about this, but there's a lot of headlines about what she's doing for the local economies as she's going to these different places too. I was even reading about how how they transport the stage from place to place. She's got like this whole crazy system for setting it up and taking it down, and like how the truck drivers do their schedule. It's just wild. Anyways, the companies, the other companies that we mentioned, just in terms of that ownership change. So this is public companies that are going private, Qualtrics and then Coupa were the other two, which is just, I think, all to the things that you already said, but it's interesting to kind of look at both sides of it, of why that change would happen.
Yeah, I mean, the common thread here is just these are, massive deals of what I'll call proven companies that are choosing to go private. So then that begs the question as to why that might be occurring. So, in the case of Coupa, Tech valuations have been challenged over the past year or so, where there's been just this focus on profitability over revenue. And the result of that for Coupa was, a pretty significant devaluation in their stock price. So if there is an acquirer out there that can help them change their business model in such a way that truly reflects their value and can better showcase the potential profitability they have, then it's a wise move. But I think part of the result was the market is triggering more of an emphasis on them proving to investors that they have a long-term viable business model that can showcase profitability over, say, user growth or revenue growth. It's a smart financial move that can pay dividends. And I think there was a little bit of pushback because some of their investors were activist investors and they thought the deal was a little bit undervalued. But it's a tough case to make when it's at a pretty significant premium over what investors are getting in the market. And I think in this case, the investors won out. So super interesting case with Coupa.
Yeah, I think I'm, and the risk of just duplicating what you just said, Adnan, I'm very curious. I'm very curious what they're going to do with Coupa. I don't know. I know that obviously they're going to make some changes, obviously, and they should. Obviously, I think the focus is going to be and should be on profitability and how it's going to be different or unique moving forward. I was even trying to think through, is there synergies that are better suited than their previous sort of world that could be put together with them to increase that valuation. But I'm just not sure yet, and it'll be very interesting to see how that unfolds.
Or maybe it's a combination of both, where it's a little contrarian, where Coupa's board of directors thought that they actually had the best growth case or the best profitability long-term case by growing users and volume rather than short-term profitability. And if they go private, they can continue with that strategy before merging when maybe the market values something different or they're in a better position to leverage that user base to be profitable.
Yeah, it's a good point. And that's likely somewhere, the story is somewhere in there. But I think I go back to what Adnan just said. I think the tech market has gotten tighter. And I think there is a push for profitability. And these software companies that were valued like 10x, 40x, 35, whatever those huge numbers are, all of a sudden now it's like, I don't care about your user count. Tell me, I've been invested in you for 15 years. I need to exit, I need to get out. How are you going to make me money? And I think things have gotten tighter. It really has gotten tighter. And frankly, it's, Silicon Valley has a tendency to do this. It's moving to AI. It's moving to more of this sort of language processing and things like that. It's just kind of, drifting. The capital is drifting there. So, maybe some of these things are a little bit of ancillary damage to the funding kind of shifting to other areas. I'm not sure. But there is definitely, we've been seeing it, a big push for these software companies to start showing that they can make money and not just acquire users or volume.
I was just going to say, I think, and that's where pricing power can play such a big role, because the other side of the coin is, we were on a project recently and we did some competitive research, as we often do, and there's a private company that had a massive valuation relative to the revenue they were generating. It was in the realm of I think 70x, if I'm not mistaken.
Yeah.
So point being that in that scenario, what our findings dictated was there was just such significant untapped pricing power that they had left on the table because their intention was right now to capture market share, create stickiness, and over time, the likely thing that they would be doing is to further leverage that pricing power. So when my hypothesis is that they've painted an investment thesis that articulates that, and that's why they've gotten to such a large valuation. So point being, if companies are able to prove this out via their investment thesis without necessarily having shown it in the financials, these valuations, can be up there quite high. But it's a matter of just proving that out in a very kind of clear way.
Adnan, I know you did some research on it, so maybe you can fill us in. One of the things that it came up on in your research that I liked a lot was this network effect, right? So this company was in multiple businesses, multiple verticals, and they were leveraging information, and rightfully, from one to the other. So they created this stickiness that was just incredible. Can you talk to us a little bit about that? Because I think that's an important one for us to discuss and also talk about the effects of it.
Yeah, absolutely. It's a super interesting topic. So, the easiest kind of way to explain it is if you think about any type of a social media platform, whether it's Snapchat, Threads, etc. The benefit of a social media platform is when there's many people on there. If there's 5 people on there, there's not much of a reason to go on there. But if there's 100,000 or 1,000,000 or 1 billion people on there, then it becomes very interesting because of the volume of content being generated, the fact that more and more people will go on there. So there's that exponential growth over time. And what we're now seeing is in the B2B space, when, say, information is being generated for B2B companies and companies are able to benefit, there's a way to benefit for both the user themselves as well as the business as a result of more people signing up for that platform. Then that network effects shows itself. And once you've proven out the case for that network effect, that's where the pricing strategy comes into play. Because in this case, what was happening is they saw that the benefits of the network effect were so important in a couple of different ways. One, it creates stickiness, meaning that their partners would then be more attracted to their platform. And then 2, it creates that kind of, they're able to capture market share, which will increase their pricing power over time. So those 2 factors came into play, and again, they're not. I think they're intentionally not fully monetizing because they want to capture market share, and then over time, again, they will likely raise prices that will justify their current valuation.
Yeah, one of the things that these guys did, which I really liked, is they looked at, we call it dynamic value drivers, and Pete alluded to it before also, which is they kind of jumped the competitor and they jumped the big behemoth that's in the market life cycle now. So they kind of understood that, hey, there's a market that's here. It's a good market. It's strong. It's profitable. But there's pieces, there are value drivers that are being missed. And we might be able to serve those value drivers better if we were more of this technology-enabled company that was able to leverage data from multiple other sources. So in effect, they kind of went into this and they were looking at it from how will these how will these B2B companies make decisions in the future? What is going to be important to them? What are the critical value drivers 2 years from now, 3 years from now? And they started building and leveraging this network effect to start getting in. So what happened is this giant company said to themselves, oh, we don't have to worry about this little guy because we're the biggest one and we're addressing the need that these customers have today. And they're not wrong. These customers truly have those needs. And this giant company has a differentiated product and it's great. But this little company comes in and completely kind of jumps over them and starts a new technology curve, a new S curve, a new market cycle, and they're able to get into this thing. And you can see the alignment with future value drivers with what they're doing today. And they leverage that network effect. They leverage this sort of notion of dynamic value drivers and how decision-making will change in the future and build a business model around it. I really, Adnan did the research and, we were reviewing it and I was thoroughly impressed by what this company did. It was really textbook. It's really good. Now, I don't know about the 70x valuation they have, but still, it's still a good company.
In terms of like making that shift from static to dynamic drivers, what do you think are the biggest things that people will have challenges with, or the biggest hurdles in that change?
First of all, I think companies are built to hit what they're promising the market this quarter, this year, this month. So we automatically become extremely short-term focused. And the whole notion of dynamic value drivers is to think out 2 years, 3 years, and understand your customers that are out there, how are they going to make a decision tomorrow? Not today, but tomorrow. And once you start having that mindset, is all of your portions of your organization aligned to it? Is your salespeople asking the right questions to understand that future market? Are they understanding what it would mean to solve for those things that are going to be a need 2 years from now? Are they taking that information, giving it back to product development, R&D, and other places where they can evaluate properly and understand? And the other thing is, honestly, just the way Adnan just explained it, is are you looking at your competitors the right way on an ongoing basis? Because the notion is the market will change. These needs are going to, customer needs are changing, market's changing, the demand is being affected by higher interest rates or whatever else that's out of your control. So all these things are dynamic in nature. And because they're dynamic in nature, your competitors are dynamic in nature, right? They're coming up with new features, new functionality, new products, new competitors are coming in. And if you're not monitoring that dynamic nature of the environment, then you're going to be left behind. And that's the key, I think, for us moving forward, to be able to put all of those things together in a process to have that ongoing closed loop environment moving forward.
Gee, I think that's a great example. I'm thinking about this commodities industrials provider we're working with now. You think about like a public company, and you get the scoreboard every day with movements in the stock price based on every piece of new information that's going on globally or in your industry, interest rate wise, et cetera. And when you're in a private company, you don't really have that real-time scoreboard most of the time. Certainly investors don't, but oftentimes management doesn't either. And so I think that the building that capability to see, okay, well, what are the things I need to be listening for and looking for? Because those values are changing day to day in the same way. They're just not visible. And so if you acknowledge that to be true, then it really is important to have like, what's the listening cadence and event and really consolidation of that information in a way that I can make a decision on it or understand what's going on. And so that's really the process that we're helping these companies build.
Yep, that's right.
It's a super interesting topic, just because, you know, in these scenarios that we're describing, what we're often doing is looking for external data sources that can help us get a sense of how is the value of what I'm selling changing based on any type of external indicator out there. And I think what I'm learning is that it doesn't have to be terribly complex. There could be some relatively straightforward external indicators that can give you when you look back historically, can give you can be reflective of your business trends. And then from a future perspective, you can get a sense of, okay, this is where we end up. Because I think one of the things that I'm seeing a lot with companies is that, you know, depending on the market they're in, because of the market, there's been a bit of a downturn. So the question they're always asking is like, well, how much of that downturn has been a result of the market, or is it a result of me perhaps losing market share to a competitor? And if you're losing market share, then that would dictate, you know, a bit of reflection and perhaps reassessing strategy. But if it's the market itself, then you can wait it out, or perhaps you start to enter new markets and such. Point being that there's different strategies you want to pursue, but knowing that information is really important, I think, core to the strategy from a pricing perspective. And again, it doesn't have to be terribly complicated.
All right, you just made me think of something else. This is a little bit jumping topics, but I saw these numbers this morning. They stood out to me. So just in terms of like struggling markets, this is numbers for IPOs in the last couple of years. There have been 150 IPOs since the beginning of 2022, $19 billion in proceeds. In comparison to, in the year 2021, there were 416 and 155 billion, which I thought was, I don't know, it was surprising to me that it was that drastic. But I could also see, based on a lot of the things that you just said, especially when you were talking about tech, Jeet, like it makes sense, you know.
Can you give me those numbers again? I think
yeah. IPOs. So in 2021, there were 416 IPOs. And then since the beginning of last year, there were 150.
Yeah. Yeah. That makes sense. That completely makes sense. I think there's a lot of excess investments in cash that's out there. And I think people are consolidating to profitability, even in our relationships with private equity firms, right? There's much more of a focus on profitability, quicker profitability than there is of, let's go get market share, let's go get volume, let's go get, whatever it is. We're getting more and more phone calls about how do we turn this thing around? We need to make profitability. We need to focus on profitability quicker. That's been different than, in my career as a consultant and even in industry. It's definitely a different environment. Cash is king. Again.
Okay.
It's no longer users on your Facebook account.
Right. You know what's interesting? Also, I feel like we've had 3 or 4 of these roundtables since the initial Reddit thing came out about their API pricing. They still haven't done the IPO. I was looking at a couple different articles today. It was like there's just been so much back and forth with that CEO and what he's trying to do, and people speculating of what he's trying to do, but they still haven't officially moved forward.
Yeah, it's like we talked about. That's going to be tough. It's going to be really tough.
Just in terms of hearing those numbers, I think one of the things that comes to my mind is there's a slowdown in IPOs. So yes, that emphasis on profitability could be there, but then I guess what I'm questioning is, does it also imply that there's other funding sources that are viable, such as, okay, we can get money in the private markets, so perhaps we don't need to go through the cost of going public just from a financial auditing perspective and an overhead perspective. So because that capital is readily available, it's easier to go down that path.
Yeah, it would be interesting, to your point, Adnan, to do an analysis on cash, right, and just to see who's making money off of what, because you could make a argument, and I don't have any data to prove this out yet, but you can say that there's a lot of people that made a lot of money on Facebook and whatever else, all these technology platform companies that had come out, and then they use the money to open up private equity. So I wonder what the private equity firm that assets under management, how that has grown since 21 to 23. To your point, Adnan, that could have just be the shift. The shift could be, I don't need to go do an IPO to make money. I can just go to a private equity that has the cash, and I can go in and get some capabilities, get these other things that I need to do a second pop later on. Yeah, so that could be a better way to do it. I don't know.
I think there's also a bit of an effect, just like in the real estate market, where basically interest rates are going up, and if the volumes were normalized to prior year levels, you would have prices going down. It just would be the reality. But basically, people are holding on to their house because they don't want to refinance at a 7% mortgage. They want to keep their 3% or 2.5% mortgage. And so there's less supply. So therefore prices sort of are artificially inflated. And I think there's probably a similar thing going on in the transaction market for companies too, where if you invested in something and you're not quite ready to sell, rather than acknowledging that it's taken a hit and remarking the valuation, it's kind of like, wait and see, let's just build the profitability and do some internal initiatives. We'll wait till things turn around. I don't want to take a loss yet, because there's probably an acknowledgement too, especially for some of these, the PE funds, like the deal side of it. They want to show, if they're going to ask for, the next $100 million tranche of funding, they want to show results from a prior round. And so unless you want to acknowledge that, hey, these guys put in $100 million and they're going to get back 50, you should invest with us. Like, that's a tougher story to tell. So I think there's probably a little bit of an incentive to wait and see what you can turn around.
Yeah, cost of capital definitely has a big effect on these investment scenarios, right? Yeah, the housing one is an interesting one. I not to boast too much, but I'm at 199, and I'm having a tough time saying, "Hey, I'm going to sell." I don't think I would. I mean, it's just that's too good.
Yeah.
Okay, the other thing I saw this morning, which is like a little bit of a turn, but you're just making me think of it, is inflation dropping from 9% to 3%, which also just seems like, even though it's not, I think the target was 2% by the end of next year or something from the Fed, obviously. But that change also, it seems like it's like in the final balances of how much do we push interest rates and what to expect in that arena. So do you have thoughts for implications on business?
I find it really interesting, right? Because it's a global market, and you have to look at inflation rates as a global problem because everything is connected. Your supply chain is connected globally. So if you're talking about B2B cost of goods, you're talking about B2B cost to sell, all of these things, they're all connected. So the US being able to bring it down to 3, and you compare it to the other larger markets that are out there and where their inflation rates are at, we are in a very big advantage, enormous advantage. So the question becomes, are we taking advantage of that on a global market scale? I don't know yet. I think there's a little bit of consumer perception issue and consumer sort of confidence issue, where you still hear these pockets of milk cost and egg costs and things like that. The numbers, what we're seeing is it's fantastic. I don't know how much difference there will be between 3 and 2%, but regardless, I think there's an advantage for us on a global scale to take advantage of the fact that we are we are the best in a global economy from an inflation perspective. So, I think there's some opportunities that are there.
It's been a journey with like the looming recession forever and ever and ever, and then
and not banks taking that off the table, right? And they're like, I think we're good. So there was some level of soft landing, that the way they label it. But it is a delicate balance, right? Because even in my interviews from last year with the CXOs, supply chain guys were talking about the fact that we really don't have our supply chain built for e-commerce. So I don't think that's completed yet. I think there's still issues. I think there are issues with labor markets where people don't want some of these jobs that are much more manual in nature, which is causing issues still, which is causing higher rates of some of these B2B environments. So I think we still have pockets of issues that are out there that needs to be solved for. That's from early last year. But we've come a long way, that's for sure.
There must be a lot of it. Go ahead.
I was going to say, I think some of the inflation numbers, you could argue some of it's predictable. I feel like just the intensity of how inflation happened, like if you almost think about, like pandemic was here and more or less that's when inflation, like with the lag, and you had prices kind of coming along at one level and then boom, it spiked. Every 12-month period you're comparing back to is always like the new high to the old low. And that's now right. We're kind of at the point that it's like the new high to the recent also high. So it's just like a small change. So that kind of makes sense.
Yeah, that's right. And then compare it to the global perspective, right? Which there's a huge advantage that's there. I do think it's interesting that the interest rate conversation is still a pretty strong conversation, because I don't know what's going to happen with interest rates. Obviously, I would make a lot more money if I thought I could predict what's going to happen. So I don't know what's going to happen, but it is a delicate balance that's out there, because cost of capital has gone up a lot, and it's still an issue that's affecting housing markets and things like that. And but the good news is banks have said that there was some 2 trillion or 2.5 trillion that got introduced in new money because of COVID. And so there was a lot of pent-up demand. There's a lot of cash that's there. And if you look at our monthly burn rate of that cash, we've almost liquidated that 2.5. So from that perspective, which some economists are calling the real reason for the inflation, that capital has almost dried up. So we are basically at a point of net neutral from pre-COVID days. So what does that mean? Are they going to stop the interest rate hikes? I wish I knew.
That'll be our next frontier, is reading the future. Reading the tea leaves.
We'll bring the magic 8 ball.
Crystal ball.
That would be fun. We should do a predictions one, and then 6 months later we can see how.
We can do predictions. We do predictions in the podcast, and then I'll file them away, and then we'll read them again in a year and realize how right we were.
Just edit us to 100% accuracy rate.
No dramatic reading.
That's right.
Okay. All right, cool. Maybe we stop there. We're going to try these out with different industries and see what stands out as we, go through headlines in the next couple of weeks, and we'll see where we head next.
Sounds
Thank
good.
you.
Thank you.
All right.